As questions still remain as to how Wall Street's largest bank burned up a $2 billion loss from a trading error, those in the banking world wonder, could it have been prevented?
There really isn't anything that could have been done to stop this particular thing.
Nothing that humanly was possible. I mean, they shouldn't have made the trades.
We talked to two financial analysts, asked them what exactly is the fallout from the J.P. Morgan blunder. Both agreed the most visible repercussion will be the call for more regulation, namely a piece of legislation called the Volcker Rule.
The Volcker Rule prohibits the biggest banks from engaging in what's called proprietary trading, which is trading for their own account, which is exactly what this trade was. And if the Volcker Rule was in place, they couldn't do it. The reason they're prohibited from proprietary trading is because when these banks fail, they're backed up by the U.S. government and the taxpayer.
John Manley, a strategist with Wells Fargo, says regulating the banking industry is tricky. He says big banks will always attempt to hedge risky investments.
There are risks on both sides. You cannot eliminate risk. You cannot eliminate potential losses. You can make things worse trying to sometimes. So again, I just hope that our regulators, our legislators, and our bankers behave rationally.
In this case, it will be J.P. Morgan, not the taxpayer, who will shoulder the loss. As scary as $2 billion sounds, it's not that much to the nation's largest bank. Last year, their profits alone were $19 billion. So why does any of this matter then? The loss is more symbolic, a sign of trouble for a bank known for risk management.
J.P. Morgan is known to have both the best management and the best risk management. So what we now know is that even if you're the best, you're still engaged in wild, high-risk trading, which threatens huge losses, and the executives and the risk managers don't even know it.
I suspect if it had happened 5 years ago, we wouldn't be that upset. It's just a bad reminder. It's a little bit like being slightly brushed on a bruise. It feels a little bit sore than maybe it would have otherwise felt.
Around about $2.5 million.
A sore reminder of those ugly days back in 2008 when markets crashed as the nation held its breath for the future of those too-big-to-fail banks. Now J.P. Morgan's chief investment officer is stepping down, and the ordeal has left a black eye on a bank that for so long was seen as safe. In New York, Bonnie Ghosh, Associated Press.